Over the last 2 years, AI stocks have added trillions of dollars in market value. Some companies have doubled, some have tripled. A few have done things that would normally get you audited by the laws of physics. And according to the headlines, this all makes perfect sense. AI is changing everything. Productivity is about to explode, jobs will be replaced, profits will soar, and if you're not invested right now, you're already late. But here's the part that should make you uncomfortable. Despite all the hype, most companies using AI aren't actually making more money. In fact, a shocking number of them are seeing zero measurable return on their AI spending. That's not normal, because if AI is as revolutionary as everyone claims, profits should be showing up by now. Margins should be expanding. Cash flows should be improving. Instead, what we're seeing is something very different. AI stocks are behaving like they already live in a future where everything goes perfectly, where competition doesn't exist, where costs don't matter, and where growth lasts forever. And markets have a long history of doing this right before reality shows up uninvited. So no, AI isn't fake. The technology is real. The innovation is real. But the way AI stocks are being sold to investors, that's where things start to look like a brilliant scam. And I can prove it. Everyone agrees on the headline. Artificial intelligence is the biggest technological shift since the internet, maybe bigger. It promises faster productivity, lower costs, and a future where machines quietly do the boring work while humans collect the upside. If that's true, then owning AI stocks feels less like investing and more like common sense. That belief has become the foundation of today's market narrative. Companies that adopt AI are assumed to become more efficient. More efficiency should lead to higher profits. Higher profits should justify higher stock prices. Simple, clean, almost comforting. It's the kind of story investors love because it removes uncertainty and replaces it with inevitability. But markets have a habit of punishing stories that feel too inevitable, because innovation doesn't move in straight lines and profits rarely arrive on schedule. In reality, adopting AI often means higher expenses before any payoff shows up. Massive computing costs, expensive talent, integration problems, and business models that haven't caught up yet. Progress, yes. Profits, not necessarily. And yet stock prices don't reflect that friction. They reflect belief. They reflect confidence that every company touching AI will execute perfectly, fend off competitors effortlessly, and turn experimental technology into stable cash flows without mistakes. That's not how businesses operate. That's how ideas operate. This is the disconnect. Wall Street isn't valuing AI stocks based on earnings or even near-term potential. It's valuing them based on a future where nothing goes wrong. And history is very clear about one thing. When markets price perfection, they leave no room for reality. Over the last 2 years, what people see looks almost undeniable. AI companies are reporting explosive revenue growth. Earnings calls are packed with confidence. Charts point up and to the right. Every week there's a new headline claiming artificial intelligence is already transforming entire industries. From the outside, it feels like the early stages of something unstoppable. But here's where it gets interesting. Revenue growth doesn't equal profitability. In many cases, it hides the opposite, because behind those glossy numbers sits a cost structure most investors barely talk about. Training large models, running them at scale, and maintaining the infrastructure required to keep them alive is brutally expensive. Compute isn't cheap, energy isn't cheap, talent isn't cheap, and unlike traditional software, AI doesn't magically scale with near-zero marginal costs. In many cases, the more customers you add, the more money you burn. That creates a strange dynamic. Companies are racing to deploy AI not because it's immediately profitable, but because they're afraid of being left behind. Executives don't want to be the ones who miss the shift, so spending accelerates, margins compress, and investors are told to be patient because the payoff is always just one more quarter away. Growth becomes the distraction, losses become the fine print. And then there's the return problem. A growing number of businesses using AI are quietly discovering that productivity gains are harder to measure than expected. Automating tasks doesn't always reduce headcount. Faster workflows don't automatically translate into higher profits. In many cases, AI simply shifts work rather than eliminating it. The technology is impressive, but the financial impact is incremental, not revolutionary, at least for now. This is where the market narrative starts to crack. Because stocks aren't being priced for incremental improvement. They're being priced for domination. Valuations assume AI companies will not only solve the technology problem, but also capture the majority of the value it creates. That's a big assumption in a world where competition is intensifying and barriers to entry are falling fast. And we've seen this movie before. During the dot-com era, the internet absolutely changed the world. Infrastructure companies laid cables, built servers, and connected billions of people. The technology won, but most of the stocks tied to that promise didn't. They collapsed under expectations that arrived too early and were priced too aggressively. Investors weren't wrong about the future. They were wrong about the timeline and the winners. AI is starting to rhyme with that pattern. The innovation is real, the excitement is justified, but the market is once again confusing transformation with guaranteed returns. When stocks price a future where adoption is instant, competition is irrelevant, and execution is flawless, even good outcomes can disappoint. And that's the uncomfortable truth hiding beneath the surface of today's AI trade. So what does this actually mean when you zoom out? It means the risk in AI stocks isn't that the technology fails. The real risk is that expectations succeed too quickly. Markets have already priced in a future where AI adoption is smooth, margins expand effortlessly, and a small group of companies captures an outsized share of the value. That's a very narrow path. And when markets bet on narrow paths, the downside isn't collapse. It's disappointment. This is how innovation usually plays out. Early on, capital floods in faster than business models mature. Competition intensifies before profits stabilize. Prices reflect the end state, not the messy middle. And when reality shows up with delays, cost overruns, and imperfect execution, stocks don't need a catastrophe to fall. They just need growth to look ordinary. From the inside, this is the part most investors underestimate. You can be directionally right about technology and still lose money on the trade. Because markets don't reward being early. They reward being right at the right price. And right now, AI stocks aren't priced for learning curves or trial and error phases. They're priced for certainty. That doesn't mean everything breaks. It means returns get harder. Volatility increases, leadership rotates, and capital quietly moves away from stories toward balance sheets. The uncomfortable outcome isn't a crash. It's a long stretch where AI keeps advancing. Headlines stay optimistic, and stocks struggle to justify what investors already paid. That's how brilliant narratives unwind, not with panic, but with patience being tested. So AI stocks aren't a scam because artificial intelligence doesn't work. They're a scam because markets have turned a powerful tool into a flawless fairy tale. The technology will keep improving, it will keep spreading, and it will absolutely change how businesses operate. But none of that guarantees the returns investors are already paying for today. History is clear on this point. Every major innovation creates real progress and real value, but it also creates periods where expectations run far ahead of reality. That gap is where disappointment lives. Not because the future is worse than expected, but because it takes longer, costs more, and rewards fewer players than the market assumes. So the real risk isn't missing AI. It's confusing transformation with inevitability. Because markets don't punish optimism, they punish certainty. And when stocks are priced for perfection, even success can feel like failure.